All right, so our next speaker, hi Kelsey. I work closely with Kelsey because her and I, we work a lot with our investors with self-directed IRAs. She's a senior member at Equity Trust Self-Directed IRA and 1031 Exchange. Kelsey's key role is to act as educational resource and simply the investment process for retirement account holders. Founded in 1974, Equity Trust has collaborated with real estate professionals for decades to provide IRA administration for investments in alternative assets such as real estate syndications, direct real estate investing, and more. Here to talk about all the SDIRA stuff is Kelsey Deneen, and we'll give it up for Kelsey.
Hi, everybody. All right. Okay, gotcha. I'm going to fly through these slides. Everybody's had a lot of questions today, really good questions earlier too during the tax sessions. So I'm going to leave some time for Q&A at the end. So if I go a little fast, just let me know. That's my contact info. If you call or text me, email me, I can send you the slides if you want them as a resource guide. So my name is Kelsey Deneen. I'm a CISP, which is a Certified IRA Services Professional. What that means is I get to specialize in all the IRS code surrounding retirement accounts. So keep in mind, I'm not a tax advisor. I can't give you legal or tax advice, but I can tell you what you can and cannot do in an IRA as per the IRS code. A little bit about my firm. I'm on the institutional side of Equity Trust. So if you were to call our 1-800 number, you're not speaking with me, you're not speaking with my team. We are held aside specifically for people like F Street who are working with accredited investors. We work with a lot of advisor funds, so RIAs, hedge funds, private equity, accredited investors. You guys are our world. That's what we specialize in. Equity Trust is one of the largest self-directed IRA companies in the country. Right now, we're at about 70 billion in assets under administration. We've been in the business, we're family owned over 50 years, still the same original family. So it's been a great firm to, especially like Mitch might have mentioned, we're growing very quickly. A lot of investors are now looking at the ability to diversify retirement funds further into alternative assets. So what is a self-directed IRA? Some of you might already know. A lot of people say, I already have a self-directed IRA at a firm like Schwab or Fidelity. I pick my own stocks or bonds. It's not the same thing. So Schwab, Fidelity, Vanguard, they're broker dealers. So when you select your own investments there, you're limited to a menu of publicly traded items, stocks, bonds, mutual funds. True self-direction means that you can actually diversify into private assets. So real estate syndications, funds, private equity, whatever you're interested in, the government does allow it to be held within an IRA. Interesting tidbit, the only things you cannot put in an IRA per the IRS code are collectibles because they're hard to value, and life insurance because the payout goes to you personally. It's not built for retirement assets for you to enjoy while you're still alive. All right, so why is real estate not typically associated with IRAs? It's basically because the broker dealers of the world control the narrative, right? They think that they want to market stocks, bonds, mutual funds as the main retirement asset classes, when in reality, you have a much larger range of potential investments at your fingertips. You just have to be able to diversify by having a custodian that allows it. So when people say, I've talked to my CPA, I've talked to my tax advisor, maybe my stockbroker, they tell me it's not possible or I shouldn't be doing this because it's not allowed by law. I direct them to this section of the IRS website. So it specifically says on the IRS website that trustees, and IRA trustees are people like Schwab, Fidelity, Vanguard, the people that hold your retirement accounts, they are not required to offer real estate as an option, but the IRS does allow it. So the exact quote is, IRA trustees are permitted to impose additional restrictions on investments. For example, because of administrative burdens, many IRA trustees, again, the Schwabs, Fidelity, Vanguards of the world, they do not permit IRA owners to invest IRA funds in real estate. IRA law does not prohibit investing in real estate. So this is just a very long way of telling you real estate is allowed in retirement accounts, and the IRS actually states it very bluntly on their website. So why do people use retirement accounts? Well, I kind of explain it as, different buckets of money. I think somebody had used that term earlier today. So retirement assets are usually for accredited investors a very large portion of their wealth. They usually have quite a bit of money in that bucket. Now, Knowing that they can diversify a portion of their retirement fund into alternative assets is usually very helpful to folks because they already have that cash set aside for investment purposes. So it gives you some liquidity as a source of cash. And obviously, one of the big things is the tax benefits, right? So today we talked a lot about depreciation, we talked about lazy 1031s. In an IRA, you do not have to worry about any of that. The IRA is the investor. The IRA is the entity actually on the K1 with its own tax ID number. It is not tied through to you personally. There is no need to take depreciation because there are no tax implications in the IRA as long as the investment is within the IRA account. So no capital gains, no depreciation or capture. You can basically use IRAs as a tax shelter to either defer the taxes, and we're talking about things like before tax IRAs, like traditional SEPs, simples, or if you decide to take the tax hit up front and put money in a Roth, it is tax-free from there on. So IRAs, great strategy if you're looking to do tax-sheltered investing. Just a simple visual aid, tax deferred versus tax growth. Again, the idea is that you're compounding your wealth by either deferring or in a Roth, completely eliminating the tax implication. So what type of accounts can be self-directed? The answer is anything that is an American retirement account. So if you're Canadian, you have Canadian pension plans or anything like that, they are not eligible. It has to be American retirement funds. Now the good news is any type of American retirement fund qualifies. So it could be an IRA, a 401k, a pension, a thrift savings plan, a 403b, a 457. There's many, many different types of retirement plans out there. IRAs are the easiest to work with because IRAs are individual. They're tied to you personally. There is no employer, right? It is yours. You can do whatever you want with it. You can transfer it, move it over to us to diversify into alternatives at any time. If it is through a current employer, like a 401k, usually that money is locked up until you leave the job. Once you leave, then it is mobile. You can roll it over. I have seen in some circumstances, if you roll funds from an old plan into a new 401k with a new job, sometimes you can do what's called an in-service rollover or distribution, where they will allow you to take some of that money even though you're still working for that employer. Long story short, IRAs always mobile. Anything besides an IRA, if it's tied to a current employer, call your HR person, figure out if it's mobile. Anything from a previous employer, again, always mobile. So considerations when using retirement funds. Again, you have to have an IRA custodian that allows private investments in the IRA. Because of administration, because of bookkeeping, because of all the things that go into doing a private investment, you know, a lot of custodians do not offer it. We are a very niche industry. So again, if you do need help, that's what I'm here for as a resource. Keep in mind too, any investments done by your retirement fund into, let's say, the debt fund or a real estate syndication, everything lists the title of your IRA as the investor. So when you look at a K1, when you're signing subscription documents, it will list, for example, in our case, Equity Trust Company as custodian for benefit of your name, IRA 12345, and it will use the IRA's tax ID number. Nothing is done in your name, nothing uses your social. You want it out of your name, out of your social, you want it tax sheltered with everything registered to your retirement account. Other thing to keep in mind, when your IRA does the investment, all profits return to the IRA tax shelter. So this is not money that you're taking personally at first, right? The IRA is the investor, the IRA collects any income, any dividends. When you're ready to touch that money, that's when you take a distribution and you remove the money from the IRA as a distribution. Just like any other distribution, the same rules apply. So if you're over 59 and a half, you're now retirement age, the 10% early distribution penalty goes away. The gentleman had a question earlier, if I take a distribution out of a SEP or something like a traditional IRA, how is that taxed? It's taxed as ordinary income. So distributions, again, just like if you took a distribution out of your Schwab IRA, are added to your earned income if it's from a traditional or a SEP. If it's a Roth IRA and you're taking a qualified Roth distribution, it is tax-free, okay? So again, if the whole idea is to give a tax-efficient manner of investing, tap your retirement funds, get a great return, the Roth is very popular for a lot of investors. What else? Lead time. You want to give yourself at least 1 to 2 weeks. If you've never set up a self-directed IRA before, the IRA has to be set up before you invest. If you've already made the investment personally, it is too late to sell it or assign it to your IRA. So keep in mind, you need your IRA to be set up and ready to invest from the very beginning. All right, we talked about what won't work. The idea with IRAs is that they're for investment only. So if you're saying to yourself, oh, great, I can buy real estate. I'm gonna buy that rental property that I'm gonna stick my college kid into so they don't have to bother me and they can live there. That's not gonna work. So it has to be investment only, no personal use by yourself, any linear relatives, so yourself, your spouse, your parents or grandparents, and then down your family tree, yourself, your spouse, your children's spouses. So those linear family members cannot do business with your IRA. And again, take note, that includes yourself and your spouse. So if you've already bought something personally, you cannot sell it or assign it to the IRA. All investments have to be done through the IRA from the very beginning. And obviously with the debt fund investment, with things like that, they're arm's length, right? So you're investing as an arm's length passive investor in the fund. You don't have to worry about those prohibited transaction rules at that point. What's the process? You set up the IRA, you roll over funds or transfer money from an existing retirement fund. If you're looking to add funds to an IRA, you can do that as well. Those are called contributions. Common question that I get. Aren't there contribution limits? What if my F Street investment's yielding a higher amount than what the IRS allows for contributions? I explain to people, contribution is not the same as income. So a contribution is what you take out of your personal pocket and put into a retirement account, and there's a cap on that every year. Returns on investment are not capped. So if you made an investment of, let's say, $200,000, theoretically it doubles. That $200,000 is returning as profit to your IRA. It is not capped. There's no cap on profits. All right, so you set up the IRA, you move over funds, and you make the investment. So the investment, again, subscription documents will list your IRA as the investor. The money is issued out of the IRA with us. So again, you're not touching those retirement funds. They go straight from your old retirement account at Schwab or Fidelity to the retirement account with us. We sign the subscription document listing your IRA as the investor after you've reviewed and approved it. And then we wire the money straight out of your IRA to the end investment. So again, you do not touch those funds. You're not taxed on them. They go straight from one retirement account to another. Once the funds are in the retirement account with us, the retirement account with us is the actual investor releasing the funds for the investment. Some people will say, well, what type of account do I need to open when I look at your application for this to be self-directed and allow the private investment? The answer is all of the IRAs with us are self-directed. Self-directed, again, means the custodian, the company that holds and does the administration for your IRA, allows private investments. So every IRA is self-directed. Once my account's set up and funded, now what? So like I mentioned, we sign the subscription documents listing your IRA as the investor. We wire the money out of your IRA. We return a nice package of signed docs to Mitch so he can register everything as your IRA as the investor. And then any income, so let's say you're in the debt fund, right? And you're getting dividend payments or something of that nature. That would return back to your IRA with us. Once that cash is in the IRA, if you want to live off of those dividends and take them out of the IRA as a distribution, you're welcome to. If you select for the option that allows compounding in the debt fund, then there is nothing sent back to your IRA. It just keeps on compounding in the debt fund with your IRA as the investor. So it's very straightforward. All right, and that is my info. So I left some time for questions. Go ahead.
Do you happen to know if these real estate syndication deals would subject you to this unearned business income tax? UBIT,
correct. So it depends on how the real estate syndication is structured. Important distinction. The debt fund is not an equity position. It is debt. So you get the 1099. Those are not subject to UBIT because it's interest, right? So those investments are not subject to UBIT. Anything where you're an equity owner, where there's extensive leverage in the deal, or maybe, for example, some syndicators will operate laundromats on site for tenants, things of that nature that are not passive but active businesses, that can open you up to UBIT, absolutely. What you have to do is you have to speak to usually the accountant, look your K1. The K1, again, will list your IRA as the investor with the IRA's tax ID number. The K1 will say what amount of income is subject to UBIT. Then the IRS actually gives you a $1,000 exemption. So each IRA gets its own $1,000 UBIT exemption. You take off that $1,000, you figure out if you have a tax bill due, and if there is any tax due, the IRA pays it. So you actually have what's called a 990T prepared, where the IRA issues the payment.
But by then it's too late. You need to know before you make it.
Right. So the question is, depending on the syndication and what they're doing, you'll have to run those numbers just like they do pro formas, just like they do, all their projections. You would want to ask, would this be something that I should worry about UBIT?
That's a significant rate, right?
It's trust tax rates, correct. Yes. Now, I will say, again, with the debt fund, they're not worried about that because it's interest. With syndications, generally you want to run those numbers. If they are something that you expect extensive UBIT, there is what's called an individual 401k plan. That's for people who are self-employed with no employees besides a business partner or spouse. 401ks get special tax treatment. It's different from IRAs, where certain UBIT taxation does not apply. Specifically the one tied to unrelated debt financed income, that portion of the tax calculation. It's actually exempt. So if you're self-employed, no employees besides a business or a spouse, talk to your CPA, they might want you to go that route.
Can you repeat that? It's
unrelated debt financed income, UDFI. So 401ks get a special exemption. So you might hear some real estate investors who specifically buy leveraged real estate assets through an individual 401k because the UDFI does not apply. Again, not a CPA, not a tax advisor, but definitely do some strategic planning with your CPA.
What about the depreciation that a fund spins off? Can that be used against
personal income? Great question. So because the K1 is in the name of your IRA with the IRA's tax ID, it's not applicable to your personal income. So that depreciation tied to the IRA does not pass through to you personally. It is specifically for your IRA. And quite honestly, the IRA doesn't need it because capital gains tax, things of that nature don't apply anyway. There's nothing to depreciate. Make sense? Okay.
what are your fees?
A flat $350. So we have $350 annual asset fee. Yes, and if you email me, I can send you the information so you can take a look, but it's flat fees at the institutional level.
Does your firm act as custodian for health savings accounts?
We do. HSAs, ESAs, yes. I had a question in the back.
Do you offer IRAs with check rating capabilities?
Checkbook Control LLC. Yes, we do. They've actually been so popular that we now have an in-house LLC formation service that will actually do that for you.
Is that talking about when you don't have to roll the money all back to you all the time? It would just be in our checking account and we just do the investor ourselves?
Yeah, so his question was on checkbook control in IRAs. What that is a single member LLC, so a disregarded entity. The IRA is the 100% owner of the LLC. The manager of the LLC is you personally, the IRA holder. So what it does is instead of having all transactions flow through your IRA directly with us, people set up LLCs so they themselves can manage the bank account and then everything flows through the LLC bank account. Now, if you ever want to touch those funds, the LLC is owned by the IRA. So eventually when you're ready to touch that money, it has to flow back to your IRA. And the way it looks on our balance sheet, on your statement, is the IRA owns the LLC. There's a certain amount of capital in the LLC. And then the income would flow back to your IRA here as income or any sort of interest from the LLC investment.
What's the difference in timing for an allocation coming from a checkbook versus coming from directly from that IRA?
Sure, great question. So checkbook, you write basically the check yourself. So you sign the syndication documents, you sign the debt fund agreement documents, you issue the funds. Out of the IRA, we send you a DocuSign package with everything pre-filled. So the way I explain it to folks is if you want it on autopilot, you want to be as passive as possible, you don't want to have to worry about paperwork, administration, record keeping, have us do it out of the IRA. It's a very simple process. We send you a DocuSign, everything's pre-filled, you click to sign it, it comes back to us, we release a wire either same day or the very next day. Very, very simple. The LLC route, you are the manager, you're now responsible for all the record keeping, right? So now you need to basically sign the subscription documents or debt fund agreements, whatever they are. You need to keep all those records on file because as far as we're concerned, the only thing that we show record of is the LLC investment, okay? So it's two completely different service models if you wanna look at it that way. Usually we see checkbook control for people who are doing a lot of renovation projects where they're working on a big, let's say, commercial deal. There's a lot of different checks to contractors or something of that nature. And going to us for every single check is just not realistic if they need to write it right then and there. The other reason we see that is if they're buying properties at auction, right? Where they have to have a unique bidder ID, they have their LLC listed, they have to cut a check at the end of the auction. So those are usually the most popular use cases. So it's a flat fee. So I want to say the 990T preparation we do is $100, and I want to say the payment itself, when we issue the payment out of your IRA, is something very simple. I want to say it's $30 for an outgoing wire. So it's extremely straightforward. They're all flat fees.
So you said $350 per asset.
Correct.
So if I had one of the 10% accounts and I did 3 deals,
Mhm.
it would be $4,350.
If you had 4 separate assets, so 4 separate syndications, debt funds, private equity, it's $350 times 4, correct?
Can you purchase IPOs inside of there?
Yes, absolutely. So that per asset is regardless of value. So it doesn't matter if you're writing a check to invest in an IPO or the debt fund for $200,000 or if it's $50,000, flat fee, not value based. And any type of asset is subject to that flat fee. So it could be a startup, it could be bank stock. We see some people fund de novo bank institutions, private equity, hedge funds. Yes, any type of asset.
I guess to add on to that question and this one, would checkbook control then avoid the multiple fees?
Yes, you're thinking correctly. So the LLC is considered one asset in the IRA with us, regardless of how many different assets the LLC owns. Now, I will say this, the operating agreement for the LLC that we offer in-house basically outlines it's for real estate investing purposes. So as long as that is your focus, we can do it turnkey for you. If you want to do many other things, some people say, well, I'm also looking at crypto, I'm also looking at venture capital, then that's fine, but you'll probably have to have your attorney or someone who can prepare an operating agreement specifically for a self-directed IRA-owned LLC. So the operating agreement has to mention what we call ERISA laws. That's the law that governs retirement accounts. It has to say your IRA is going to be the investor. Again, because it's been very popular, we now have an in-house service that offers it for real estate purposes. If you're going to get more creative than that, make sure you have an attorney or somebody who can draft that operating agreement for you. Any other hands? No? All right, wonderful. Well, thank you guys for your attention.